Welcome to This Explainer. Today, we're throwing on our greasy overalls and treating Wall Street valuation like what it often is, a totally chaotic mechanics garage. We're going to pop the hood on stock valuation to see what a company is actually worth underneath all the shiny paint and flashy marketing stickers. Because, let's be real, the stock market can be a wildly irrational place.
I'm sure you've asked yourself this exact question. You look at a business that is just torching cash, has a terrible product, it's run by a CEO who tweets at 3 in the morning, yet somehow the market says it's worth $1 billion. How does that happen? Well, it happens because the market price is heavily driven by supply, demand, and human emotion. Half the time, it's completely disconnected from reality.
So as financial mechanics, we literally don't care about the sticker price on the windshield. Our goal is to find the intrinsic value. Intrinsic value is a stock's true theoretical worth, and it's based entirely on the actual cash it's going to generate in the future. We are completely ignoring what the irrational market is currently paying. We just want to know if the current stock price is an overvalued lemon that's going to break down or an undervalued steal.
Before we grab the power tools, we need to understand exactly what we're buying. Think of enterprise value as the whole truck. It includes the value of the actual business, plus all its debt minus whatever cash happens to be in the glove box. It's the true cost to buy the entire operation. Equity value, on the other hand, is just the slice of the pie left over for the shareholders after the bank takes its cut for the debt. It's the driver's seat. When we buy stock, we're just buying a piece of that equity value.
Okay, let's dive into this and bring out the absolute heaviest power tool in our garage, the discounted cash flow model, or DCF. Now, the fundamental rule of finance is that $1 today is worth more than $1 tomorrow, right? So the DCF model takes all the cash a company will ever make in the future and mathematically shrinks it or discounts it back to its present-day value. Add all those discounted years up and boom, you've got your company's value.
But how do we actually shrink that future money? We use what's called a discount rate, which is often calculated as the WACC, or weighted average cost of capital. Think of WACC as financial gravity, or the friction in the engine. It's the blended cost of a company's debt and equity. It represents the required rate of return investors demand for taking on the risk of this specific business. The riskier the company, the higher the gravity, and the more those future cash flows get shrunk down today.
Now, time to reach for our first mathematical workhorse. It's a specialized wrench called the Gordon Growth Model. It's a simplified version of a DCF that looks super intimidating, but is basically pure magic. It takes an infinite stream of growing dividend payouts, literally, dividends stretching out until the end of time, and condenses them into one single, neat, present-day value. P stands for the price tag, D1 is next year's cash payout, R is your discount rate, and G is your growth rate.
Applying this is just a quick 3-step tune-up. First, you take the current dividend and grow it by your estimated growth rate to find next year's dividend, D1. Second, you just plug it into the formula. Divide D1 by your required return minus your growth rate. And third, you look at the number your calculator spits out and compare it to the current market price. If your calculated intrinsic value is higher than the stock price, you've found an undervalued gem.
Let's actually put a car on the lift and do the math. Imagine a really boring, mature utility company. It's going to pay a $3.15 dividend next year. You demand a 12% return on your money, and you think the dividend will grow at a steady 5% a year forever. You take $3.15 and divide it by 12% minus 5%, which is 0.07. Do the math, and magically, the intrinsic value of that stock is exactly $45. If the stock is trading at $38 out in the market, you buy it.
Now, what's genuinely terrifying about this math is how absurdly sensitive it is. In our base case, 5% growth and a 12% return gets us $45. But what if we're just a tiny bit more optimistic? If we bump that growth rate to 6%, the value jumps to $53. If we lower our required return to 10%, the value skyrockets to $63. This is the real danger of financial modeling. By slightly tweaking your assumptions, you can turn a mediocre lemonade stand into a massive, multi-billion-dollar empire on paper.
Oh, and here's a really fun little quirk. What happens if you try to value a high-growth tech startup using the Gordon Growth Model? Say you assume the company grows at 15%, but your required return is only 10%? Well, 10 minus 15 is a negative number. You end up with a negative stock price or an infinite one. You literally break the laws of mathematics. The formula only works if your required return is strictly greater than your perpetual growth rate. Zooming out, let's see how this builds into the broader DCF model. When we forecast a company, we can usually predict the cash flows for the next 5 to 10 years with some level of sanity. But what happens in year 11, or year 20, or 50? That is where we introduce terminal value.
It's the financial horizon line. It's the massive chunk of estimated value that kicks in when our year-by-year crystal ball shatters and our detailed forecasting ability completely runs out of gas. There are two main ways to guess this terminal value. First, the perpetuity growth method, which just assumes the company keeps generating cash that grows at a tiny, slow, stable rate until the heat death of the universe. Alternatively, there's the exit multiple method. This one says, forget forever. Let's just pretend we sell the entire business at year 5 for whatever the industry average multiple is today. Generally speaking, private equity loves the exit multiple, while academics love perpetuity growth. Here is the scariest reality about popping the hood on a DCF model. The terminal value, that giant, educated guess about what happens after year 5, often makes up 60 to 75% of a company's total implied valuation. Really think about that. You can spend weeks agonizing over next quarter's payroll expenses, but the vast majority of the company's calculated value rests on a massive philosophical assumption about what the business will look like decades from now. To brilliantly illustrate why this is so dangerous, take a real-world manufacturing example from our sources. If we assume a 2% perpetual growth rate, our terminal value is $294 million. But if we nudge that up to a 4% growth rate, the terminal value balloons to $412 million. A tiny 2% shift in our assumption about perpetual growth swings the total enterprise value of the company by over $100 million. Because these models are so incredibly sensitive, it's way too easy for sloppy financial mechanics to accidentally build a model that just flat out lies to them. So, it's time for a rapid-fire roast of the absolute worst sins in the financial modeling world. If you want to find the true intrinsic value of a business, you have to make absolutely sure you aren't making these rookie mistakes. Here are the cardinal sins. First, never include cash flows from the past. A DCF only looks forward, starting at year 1. Next, make sure your rates match. Don't use WACC if you're only valuing the equity. And here's the funniest rookie mistake: calculating a massive terminal value out in year 5 and entirely forgetting to discount it back to today. Finally, don't ignore reality. If your DCF says a hot dog stand is worth $1 billion, you need a sanity check. So how do we actually perform a reality check on that terminal value? Ask yourself, does your perpetual growth rate exceed the long-term growth of the global economy, which is usually around 2 to 3%? If it does, that's a massive red flag. You're mathematically assuming this company will eventually grow larger than the entire global economy and take over the world. Also, are your long-term profit margins drastically higher than the rest of the industry? If so, why wouldn't competitors jump in and crush those margins? And this brings us to a deep philosophical divide in the finance world. Investment bankers generally use DCF models to justify a market price. If they're pitching an IPO or a merger, they will notoriously tweak the growth rates and discount rates backward until the model spits out the exact price they want to sell it for. But actual investors use a DCF to find the market's mistakes. They use conservative math to find companies that are genuinely trading below their true intrinsic value. So we're closing the hood on the financial mechanics garage today, but I want to leave you with this final provocative thought. If the terminal value dictates up to 75% of a stock's theoretical worth, and that terminal value is highly sensitive to tiny tweaks in growth assumptions, whose wild assumptions are currently baked into the stocks in your own portfolio? Are you paying for a realistic future, or are you just paying for a spreadsheet error? Thanks for joining me on this explainer, and keep questioning the math.